Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with the podcast, my guest and I will do a weekly podcast on all things real estate, from interest rates to the economy to what's happening in Washington to what's going on at the Federal Reserve and the decisions that they're making that obviously affect the overall economy, but specifically the stock market and the real estate market, which they have been for some time now. We try to really dive deep into, these basically economic reports that are coming out each and every week. We mock them most of the time because they really don't really mean much, because they can obviously be slanted one way or the other, and if they're not, then the media does the slanting themselves. I think that, today I want to really kind of dive deep into this so-called real estate recovery that we've been talking about. Now that the snow has passed and we've got economic reports that some of them are coming in better than expectations, but really they're still terrible in my overall opinion. I want to kind of dive deep into that. I also wanted to talk, yesterday we had a big bump in interest rates, under 8.25% up. The 10-year note was rising up, basically because there have been some talks over at the Geneva Convention that it looks like the potential Ukraine and Russia situation has been potentially or possibly diffused. When that happened, it looked like a lot of money was pulled out of the safety of bonds, and obviously mortgage rates rose. So we'll see what happens today moving forward with that. We'll dive a little bit further into that. Joining me on our panel, as he does each and every week, is Louis Camerosano, who is a former school teacher, a former attorney, a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert. He's been cited in Inman, Fox Business, Wall Street Journal, U.S. News, Wall Street Journal, and many others. Louis, how you doing today?
Hi, Ryan. I'm doing grand. How are you?
I'm doing well. So, we've got quite a bit going on over the last week or so. Yesterday, I believe Janet Yellen spoke again, and I kind of wanted to start the show off with her comments because, as always, she's optimistic that things are moving in the right direction. I think she's still a little hesitant on the jobs front, but she did make note that she feels like the economy, she foresees it being a fully healed economy in the next 2 years, with the labor market returning to full speed and inflation picking up within this 2-year period. I think, if you remember before, I think her original comments were somewhere along the lines where she thought things were going to turn a corner in about 6 months, which is why they were starting the taper and the pullback, the consistent pullbacks, purchases of treasuries and mortgage-backed securities. But now, it looks like she's now reversed course, and now it's going to be in 2 years that it's going to be healed. And not to mention the fact that employment is really not improving that much. So I don't know where all the optimism is coming from, but they've already also basically clued us in that they plan on keeping the Fed fund rate extremely low, or at zero, for an indefinite period of time, which my feeling on the indefinite period of time is somewhere between 2 and 4 to 5 years at this point, because they've already committed to almost the end of next year with a next to zero rate, and then we pretty much are going to be coming up on the elections again. Don't think much is going to change between now and then. Obviously, you and I noted in our last podcast that we felt like if there was some sort of crisis coming up overseas, such as the Russia-Ukraine crisis that, diverts attention, that something, or China-Russia, the events and what they're doing to kind of isolate themselves and stop buying our treasuries and obviously trade with, amongst themselves to try to hurt us, that could affect us. But where do you see things going in the so-called next 2 years, where she feels like there's going to be a full healed recovery? I honestly am not optimistic at all. I don't see anything that she's seeing. I know that this is just more media speak, I feel like, than anything else. But I just kind of wanted to get your thoughts on her comments, and we'll go from there.
Okay. Well, Ryan, as you know, the Fed has been on record, and so is Janet Yellen, that the main characteristics and features and benefits of quantitative easing are rising stock and rising home prices. Okay? And you can undeniably say that they have achieved those objectives. In many areas, home prices are above or at their mid-2000 peaks. In the stock market, we've exceeded, and we're hitting record highs in the stock market. So mission accomplished in that case. If that is true, then why now are we still worried about an economic recovery? They've got it all backwards. They boosted the stock and real estate markets and expected somehow the economy to follow instead of the other way around. The economy improves, and then people have money. People can afford homes. They buy homes. They have a little extra cash. They invest it in the stock market. The stock market goes up. Instead now, we're talking about a recovery still, that somehow the economy is going to recover, and in just a few more years, according to Yellen, we're going to be back to normal, even though the stock market and real estate markets are well ahead of themselves. Now, you know the story of the old smoker, right? The person who quits all the time says quitting's easy. I've done it a dozen times. Well, that's where the Fed is. Yellen's like, yeah, we're going to quit QE. Of course they are. They've quit it 1, 2, 3, 4, how many QEs they're on. Of course they're going to quit it. And then they're going to end up having to go right back to it. What I'm concerned about, go ahead.
Yeah, and they always come back to their bad habit, which is QE.
Right, just like the smoker.
Right.
She's going to have QE light, and who knows what they're going to do. But here's the real issue, Ryan. If after $4 trillion worth of spending or printing of money, we are not back to normal, and by their own admission, they're not going to be back to normal until sometime in the indefinite future, we have to conclude it's a failure. But they are talking now, and remember that the latest issue has been the weather. They blame the weather for the last 3 or 4 months worth of bad data. Now they're pretending to see good data because the weather has improved. We see reports now that the initial jobless claims came in better than expected. You still lost 300,000 jobs. No matter. It's the lowest since 2007. You don't see corresponding job gains. That doesn't matter. At least fewer people got fired. Well, fewer people got fired because over the last 5 years, fewer people got hired, and they fired so many people. But yet they point to that as rosy signs in the economy. I saw headlines in Fox, Daily Finance, you hear the Fed talking about it, that somehow fewer people getting fired is an indication that we're on the road to recovery. And this has been a long road, and I still don't think that, we've recovered. Fewer people were fired, so what? Where are the people that are getting hired? Not happening. Now, if we go back to the stock market, Ryan, and to the housing market, if those are the two pillars of the supposed recovery, and they've already achieved their highs, but we don't have a recovery in the rest of the economy, what happens when those two slow down? Well, the stock market doesn't look like it's appearing to slow down. It seems to be hit its plateau, but it stayed there this year. We're still within a couple of percentage points of the all-time high. The housing market is the most troubling. While prices continue to rise, excuse me, we have seen in the last 3 or 4 months that inventories have exploded and home sales have gone down. Now, if you remember, the housing recovery mantra has always been the only thing that's holding us back, prices are rising, this is a great market, is that we don't have any inventory. And if the inventory was available, people would just grab it. Well, that's not true, because we've seen in Sacramento, inventory is up 71%, sales are down 12%. Los Angeles, same story. In Phoenix, inventory up 41%. Ventura County up 28%. Riverside, 25%. San Diego up 21%. Sales are down. Yet, interestingly enough, prices are still heading higher. Now, you know that can't exist under normal market conditions where you have more inventory and less demand. Somehow prices rise. That cannot continue. So that's going to stop. And if that stops, one of your pillars of the so-called recovery gets pulled away. And as you know, in the stock market, you're no more than a Friday afternoon or a Monday morning away from wiping out 20, 30% of your gains in the stock market, and then it's recovery over. And I think that's what the Fed is waiting for. They're waiting for them to be, quote, surprised that their so-called recoveries in housing and the stock market have failed, and that might be the impetus for them to have to jump back in and save the day with the excuse, everything was going fine, who could have expected this? When all the signs are there, you've got an overpriced stock market with companies like no-profit companies like Tesla, Netflix, I don't know if they make profit, but Twitter and so on, with multi-billion-dollar valuations. You've got home prices through the roof with absolutely no demand and exploding inventory. So, Ryan, what's going to happen when those creations of the Fed fall apart?
Well, it's a great question. I mean, I think that it is a mess. I don't know, and I think that they really don't have an answer for what they're going to do. They're just playing it.
Well, they don't expect it to happen. They think the weather's getting better. It's going to keep going up.
Exactly. I mean, it's just now that the sun's out, the housing market and stock markets can continue to climb, and that there's not going to be anything that they have to do. Inevitably, they will, and they'll have to do something in the form of some sort of easing or printing or whatever they want to call it, some lending to small business, lending for infrastructure. Who knows what it's going to be? But there's going to have to be something because, as you mentioned, they've basically accomplished two things by driving up the stock market and driving up housing. And what does that obviously do for the country? Well, it actually gives that positive consumer sentiment, right? It gives the feeling or the appearance that everything is peachy, right? That everything is moving in the right direction. But the reality is that although we have stock prices and home prices that are rising, the actually employment situation and wages are actually moving in the opposite direction.
Right.
Right? So, I mean, just if you look at that, you can't possibly have a recovery when those two things are moving in an opposite direction. You can't. It's pretty much impossible.
Unless you redefine recovery the same way they redefine what inflation is.
Exactly.
You strip out food, energy, and anything that you need, you could say there's no inflation. Similar here, if house prices manage to eke out a gain, even though the rest of the economy is in the toilet, they can say, well, there's been a recovery, housing prices are up, and the stock market's marginally up.
Well, and on our podcast, Real Estate 360, we like to look at things for face value, right?
Right.
We're not out there creating our own definition. And if you just look at this basic concept, if you have wages and job growth going in one direction and you have housing and stock prices going in a completely different direction, that's not good. That's not good for a stable economy for sure. And, typically when you start to see some sort of recovery, it's led by jobs. But for the last 2 years, it's been led by artificially low interest rates.
Right. And what they call the job recovery being led by is fewer people getting fired and applying for benefits.
Yeah, absolutely.
That doesn't mean more people are getting hired. I repeat that almost each and every week, but they keep pointing to it as if that's a sign, some kind of signal. In fact, some of them actually interpret it as being job gains. You actually see from major news reporting outlets calling it job gains when fewer people get fired.
Yeah, well, I mean, wasn't it like one of the last articles, I think, for this past week was like jobless claims at like a 7-year low or something like that.
Yes.
Right? I mean, come on, guys. Really? The consensus was 316,000 or something like that, and the actual was 304, and we're jumping up and down about that. I mean, this has been consistently week after week terrible numbers. If you go,
they're going down. So what? There's fewer people in the labor force to fire because we've had the labor force eviscerated over the last 5 years through mass layoffs, jobs going overseas, and fewer people being hired during that time. So, of course, fewer people can be fired in the last couple of years.
Right. There's fewer people that can be fired. There's more and more people that are falling off of unemployment. There's more people that are frustrated and no longer want to enter the workforce. And then
if we're at pre-recession levels and you want to take their argument, by all logic, then you would say, correspondingly, if fewer job claims, unemployment claims mean job growth, then we'd see job growth, and we don't. We only see a drop in the unemployment rate, which is a function of fewer people in the job market. The job participation rate has gone down each month for the last 5 years. I think it ticked up last month a very small percentage, a fraction of a percentage.
Yeah, and then we can jump over to, the fact, okay, great, we've got rising stock prices, we've got rising home prices. We would think the economy's moving in the right direction, as Yellen has mentioned. But then we come over to retail sales. Retail sales was expected to be 0.8. It was 1.1. Don't you think if we had a real recovery going on, that we would have retail sales up 2-3% somewhere, right?
Sure. And Ryan, the thing about retail sales is that's borrowed money anyway, because we now know in the last year consumers have stopped saving money and they're back into they're back into increasing the amount of debt that they hold per household, which isn't good. And it's probably because they're convinced that the economy is getting better, so they're borrowing more money, or because their homes now have equity, so they're drawing down on that and spending money they really don't have.
Yeah, and the articles we've been mentioning about, okay, so they've accomplished the mission of getting the rising home prices, which we had talked about before, that there was this huge influx of potential home sellers that was going to come to the market because they were no longer going to be underwater, right? Mm-hmm. I think I just saw an article the other day. I can't remember where it was, but it was 2 million people are basically going to be ready to sell their home this year because they're now above water. And you and I mentioned, and I talk about this in great detail in one of our prior podcasts, that just because you get your head above water doesn't mean that you can sell your house. Because right off the top, you still got 6% in real estate fees. You still have your county and state tax stamps or whatever else you're going to have to pay in recordation charges when you sell your house, any transfer charges. You're also going to have, if you have to pay for the buyer's closing costs. So before you know it, we're at 6 to 10% that still has to come off the top. So that's not enough for you to just get your head above water. You not only have to get it above water, you have to get it another 10% above water, and that's just to break even. That's not.
And that's assuming you want to sell in the first place.
Exactly. And how many people are actually thinking about specifically selling and buying another home? I would imagine, based upon the jobs information and us knowing that there's not any wage growth and there's really, many people are just going to stay put. Now, granted, here in the Washington, D.C. metro area and, in New York and in California, San Francisco, and areas like that where jobs are more plentiful, we've seen huge increases in the house prices, specifically in these areas. And a lot of that is coupled by the fact that we do have low interest rates and we do have a better job environment than the rest of the country. Mm-hmm. Right? So we do expect for these anomalies to exist within the United States. But this is not what's taking place, in every single city and every single state.
Absolutely not. It highlights the thing about QE. It benefits the rich. And all those cities you mentioned are places that are very well off. New York, Washington, D.C., San Francisco.
Absolutely. Yeah, and
not the same way in Buffalo, Birmingham, Syracuse.
Yep. And, one of the questions that I get all the time, Lewis, is that, when I'm listening to the podcast and I hear a lot of the negative light that you're putting on the economy, and unfortunately I have to tell people that, I don't actually feel positive about the economy and where it's going. Now, that doesn't mean that I'm not realistic and I don't look at things for what they are and try to take advantage of them the best that I possibly can, right? Those are two different things. I can be pessimistic on the overall economy, but I can still be an optimist in my business and take advantage of the opportunities that
you could be invested in the stock market even though it's a mirage. You could have made a lot of money in Tesla. You can criticize those companies all you want, but there's real money to be made buying these companies at $20 and selling them at $100, even though those valuations aren't justified.
Exactly, but I think that the key point is that I'm not going to get sucked in by the media's hype of what what the stock market is and what real estate is.
They justify it, Ryan. They justify all these prices are justified on historic PE ratios. Housing is back. They insist that this is real, mainly because they don't know the difference. And they've been told that it's real, and they've been told that the Fed is the Wizard of Oz, and they can fix the economy, and they have fixed the economy, and they use terms like escape velocity and the rest of the nonsense. That's why people actually believe it's real, and it's only people believe it's not real in large numbers once it's self-apparent after the fact. Most people cannot see a bubble if it smacks them in the face, and you've seen that with the Fed. You've had Greenspan, Bernanke, Janet Yellen, all points in their careers denying a bubble exists, when many people said there was one, and then, of course, after it happened, they do recognize there was a bubble, and then they say, well, who could have seen it?
Right. Yeah. Well, at the time, based upon the information that we had in front of us, there wasn't a bubble, right? This is what goes on all the time, and I think, part of why we do this podcast is that, if you understand what's actually taking place behind the scenes, and if you can basically, get through, all the national articles that are put in front of you through TV, radio, the internet, and you can actually break those down. It really will give you a better understanding of what's taking place. It will help you make a more informed decision. It will help you be a little bit more cautious in your dealings with real estate and the stock market, because your job is to kind of forward think, right?
Brian, do you think that the media or the Federal Reserve is going to come out and say, this isn't real, this is a bubble? Of course not.
It would scare everybody off.
And it would be self-fulfilling prophecy. So what they do is they do the reverse. They want a self-fulfilling prophecy, that just like the Wizard of Oz, that it works. So they claim recovery and gains, and they have justification. There's low inflation. There's high asset values. There's a wealth effect being created. And they can ignore and cherry-pick the data that they wish.
Right. Well,
and feed it to the media. And the media, as you know, the mainstream media is no longer investigative reporting, looks at things with a critical eye. They serve their data masters and their advertisers.
Yeah,
they don't look at it critically, because they'll get fired if they do.
They would get fired. Exactly. And, I subscribe to many blogs because I like getting, the slants that all these different blogs and media outlets provide. So the one specifically that I follow a lot is the KCM blog, because this is information that's kind of pushed out there from Steve Harney and or his crew that he has, writing up these blogs. But they're slanted to cater towards the real estate agent, right? They're always providing blog posts that are geared towards, really hypey, get them hyped up for the spring market, get them hyped up for the summer market, and always trying to push information that's going to lead them that this is the time to buy. Well, the headline from 20 hours ago was real estate. This spring will be different, right? Okay. So I'm thinking to myself, I know exactly where this is going. And I'll read the first few lines. Just like Mayflowers, every spring the housing market blossoms as buyers come out ready to purchase their dream house. This spring, we believe we are going to see the strongest purchasing market we have seen in a decade.
Of course.
Why are we so bullish on the housing market this spring? And here are a few reasons. And they go into millennials. They talk about, contrary to the many reports, that the age demographic is ready, willing, and able to become homeowners. And see, I actually think that the first two parts of that, ready and willing, may be true, but the able is the problem that we have, that they can't get a mortgage. So they're not really.
And why, Ryan, can't they get a mortgage? As you and I have talked about on the show, I've written on the blog, they have poor job prospects. If they have a job, they don't have good jobs. They have part-time jobs. They have crushing student loan debts, and prices are too high.
Absolutely. And why would banks want to lend? Why would they really want to lend?
Especially at these, with the appraisals coming in at prices that are 30% higher than they were a year or two ago, to a child, basically, who's 24 years old, who can't afford the house because he doesn't have a good job and he owes a lot of money on student loans.
Yeah, and I mean, do you think that these bankers aren't sitting around in the boardroom saying, hey, guys, I know I don't know if you guys are paying attention, but at this same city last month, these houses were selling for $300. Now this month they're at $315. Do you guys
let's loan some money on them, and let's get 3.5%, 4% on it.
Well, you're right, but don't you think that they're telling their underwriters, you need to be really stringent, right? You need to only let the loans go through. So that's what's happening.
Unless there's a government program that says from now on you got to loan money with no standards whatsoever to people under 30 years old, there's not going to be an influx of millennials into the market until their situation improves.
Yep. But
and that would be the worst thing to happen is the government programs and the Fed low interest rates has put them in this position, and then to ask them to help them out would be the worst thing that could happen to them.
You know what always happens with those government programs, though, Lewis, is that the bank or the lender will come out and say, yes, we do recognize this government program, and we are doing these type of deals. However, we have overlays, right? And why do they create the overlays? Because it's just a way to not have to do those. And it's exactly why, the home affordable refinance program that has been changed 3 or 4 or 5 times at this point, and, over the course of 3 or 4 or 5 years now, it's only helped a, select amount of people. It's in the millions now, but in the beginning it was very few. And there's still many people out there right now that still can't do anything. But, these programs are created to make it seem like they're really doing something, but it's not. And, honestly, a low interest rate environment for an extended period of time, it actually hurts the middle class. It hurts it, right?
Of course it does. It hurts the savers, middle class, senior citizens, millennials. The only people it doesn't hurt is people who at the prime earning period of their careers who have a lot of money.
Yeah, and so that was the first one. It was the millennials, right? That was one of the reasons. You know what the next one was? It's baby boomers, right? As prices have risen, the equity in many of their homes across America have gone up. Homeowners have been shackled to their house, and I'm reading this word for word on this article, KCM blog, shackled to their house because of low or negative equity for the last several years and are again free to make a move without worrying about bringing cash to a closing table in order to sell. We believe this newfound freedom will release a pent-up demand of sellers who want to move up to the home they've always dreamed of or want to downsize their primary residence. Now, once again, I mentioned this earlier. That's great that they've now gotten their head above water, but what is above water? You know what I mean? It's not just having a loan balance that's $300,000 and your home is worth $300,000, because that doesn't work unless you're selling it for sale by owner, which we know that typically you're going to get a much lower price than if you were to actually use a real estate agent. So
right.
That's kind of out the window.
But Ryan, this article, when was it written?
It was written April 17th, as of yesterday.
Okay, it sounds like it's following an article I wrote on March 20th called "Who Will Buy the Homes to Support the Housing Recovery?" And the first two I listed were millennials or baby boomers. And he just gave a sunny situation for millennials, and I pointed out that no, they're not in a position to buy the homes because of high unemployment, underemployment, crushing student loan debt, that household formation is low amongst them because of the prevailing economic circumstances shutting them out of the housing market, and that higher mortgage interest rates and higher home prices will push ownership further out of reach. Then he goes into boomers, talks about their equity situation. I wrote a very small paragraph saying aging baby boomers are not looking to buy new and larger home-priced homes. Many boomers will be selling their homes and searching for smaller accommodations. They may move in with relatives or move to retirement homes, but most won't be buying new and larger homes. Is his next one move-up buyers?
No.
Or foreigners? Because then I covered those as being not likely candidates.
Yeah, he ends with that prices and mortgage rates are on the rise. And that, obviously that, with the confidence of where prices are going and low interest rates that people do to make a move before interest rates get higher, which has always been the mantra of many of the, the real estate peddlers, NAR, or anybody else, is that, hurry up and make the move before interest rates go up. You're trying to instill.
Yeah, people are just going to rush into something that they have no ability to either get. They can't get a mortgage or to service a mortgage, but because rates are rising, they're going to want to get some before that opportunity goes away. That's the stupidest argument you ever hear. Is that
it is?
That was the old buy now or forever be priced out of the market.
Right.
It's the same nonsense. What the thing with the move-up buyers, it's kind of part and parcel of your argument that even though once you're above water, you're not above water, you can then just redo your numbers, Ryan, to include what you really need realistically to be above water, and that number then jumps from 25% from being underwater up to close to 40%.
Right. Yeah.
And once you get to that 40% number, you just removed all those people from buying or selling a home. It's no longer a possibility. And then if they themselves have stagnant wages, or because the way things are, they can't move anyway to a new place, they're not selling their home, and they're not buying a home. And he didn't mention that baby boomers also have student loan debt, many of them, because maybe they've paid off their loans, but they've signed for their kids' loans.
Yep.
So they don't have the financial resource, at least in the middle class they don't, to support their own housing purchases or millennials. So it's a farce. There's no demand for housing from your normal, traditional, first-time home buyer, which would be your millennial, or even your move-up buyers because they're locked in. The only people that can buy homes are cash investors, and they're not stupid anymore. They're not going to buy homes that have appreciated so much to the point where they can't sell them to people because there aren't enough people who can buy them at these prices.
Right. Yeah, and I mean, and I think that's still one of the things in like the DC metro area. Like, although we've had a huge increase in home prices, there's still a large amount of number of people that are still underwater from the last go-around, right? So, and what I'm actually seeing is that our inventory in many of our cities, are the suburbs, but even into the major cities, is that there's still many people that are still like way away from getting their head completely above water. It's because they went so far back. And I'll give you a prime example because I know this neighborhood. It's right around the block from me. It was townhomes that were selling in the prime, probably close to 4.25, right? Mm-hmm. They went to 4.25, but then in the worst, they got down to almost 200,000. Okay, that's huge. That's such a huge, substantial difference. Well, now, as the greatest things are gone, where do you think they are today, Louis? They're at 325. That's still $100,000 off where they were in the height of things. So there's plenty of people. Now, a lot of people have been foreclosed on. They went through a short sale so that they're out of their situation. But there's still many people that hung in there that, they didn't lose their job and they still are continuing to pay their mortgage and they're looking and they know that they have a bad asset there. But they're not really worried because they might have a mortgage interest rate that's decent that they're just going to continue to pay down on, and it's not a big deal. But the point of the matter is that we have not seen a good enough economic recovery to get anywhere near, even in all this artificial manipulation of interest rates is driving up prices, but it's still nowhere near the levels that we had the last time.
But Ryan, right? Let's look at the pricing of homes versus the ability of people to afford them. Now, you mentioned in your area, D.C. is one of the few areas where, on the whole, the prices are higher now than they were at their 2008 average. However, in most places, that's not the case. The 2013-14 prices are still lower in almost all the metro areas than their peaks. Yep. Okay, so that means you've got all those people in an area where the average is now higher, but the economic circumstance isn't as good. Those prices can't be sustained. And then where the prices are lower, that means there's more people underwater.
Yep.
Which means then they can't sell, which means they're also not going to buy. So you've got this low demand environment with some more increasing inventory, and not people able to buy the homes at these higher prices. It can't last. Even in your D.C. metro area, Ryan, it can't. What's going to happen in your area, I predict, is you won't get rising home prices, but you'll start to get rising sales because people will drop down a bit. There's still demand in those areas.
Yeah, absolutely. Well, I mean, and I'm very cognizant of the fact that, we almost have a third of the sales that are cash deals anyway right now, right?
Is that going to continue?
I don't think that it will once the inventory levels spike up. You know what I mean?
Right.
Because naturally, things are going to tail back because that means that the prices are probably rising up even more. Investors are going to be less apt to go after deals. But what's funny is that so when all these investors come in and they do these rehabs, and they then get a house, like let's say they rehab a house, they bought it for $600, they rehab it, they put it back on the market for $800. What do all the other regular homeowners around there that haven't rehabbed their homes, what do they think their home is now worth?
They think it's worth as much as the one that rehabbed it.
You got it. So that's what I see as a common theme. It's like, ooh, look at that house. That house just went on the market for $800. Time to sell.
And what does a buyer look at their house and say? I'll give you $6.25 for it.
Exactly. They're saying, well, we don't care that you think that your house is worth this. We're going to offer you this. Or they don't even look at that house because they look at the pictures online and they're comparing it to the renovated one that's sold up the street. They don't even look at it. So
it is amazing how people do not look at homes and have any ability to see the value of a home that just hasn't been cleaned up and painted.
I agree with you 100%. I mean, there's part of, obviously, I invest in real estate pretty heavily, and I pay attention to different things, but I just looked at a house last week that it needed all new floors, needed a new kitchen, all these different things. It was a sale from a guy that was, his parents had just passed away, and he wanted to just get rid of it, and he didn't have the money to fix it up and sell it, so he's going to sell it at a lower price, obviously. It was in Springfield, so it was about 15 minutes outside the city, West Springfield, Cape Cod. Wanted to sell for about $375,000. Now, you can look at the comps and you could say, okay, well, there's some other regular sales in here that are comping out at about $450 to $475. But then on that same street, there was one that was a similar assessment, similar square footage, just a little bit of a different style house It closed, Lewis, at $580,000. Now, do you see the disparity in pricing between those, right? But what it is, it's very confusing to the average consumer to figure out, okay, where should this home price be? So you have a lot of unrealistic expectations amongst buyers as to where homes should be priced at right now because there is such a big spread between them.
You just raised an interesting point of why home prices are rising, because on few sales, the investors fix up the homes. They're able to get the higher price. Those homes sell, but the others don't because the people won't sell them at the price that they're worth because they haven't put the money into them. So that's how you get higher prices on low volume.
Exactly, because when you start to average those out, what is it doing? It's driving up the prices, right?
Even though there's few sales.
Yeah, and realistically, what I did on this specific deal was I went through and I told all the comps, I don't care. See, I never care about what's active. I don't even care at what's under contract. I only care at what's sold, right? So I'll look at comps of what's sold in the last. I'll look at what's sold.
The rest is wishful thinking until it becomes something.
Exactly, because even if I called the agent and I say, "What are you under contract for?" What happens if it doesn't go through? Right?
Yeah, you can't count that. Right.
It doesn't do any good. So I look at comps that's sold in the last 90 days. And many people are like, well, you're only going to look at 90 days? And I say, well, typically lenders only care about the last 90 days. They want at least one solid comp from the last 90 days. So I pulled everything that was around that street and that subdivision in the last 90 days. Now, there was stuff that was down in a lower range of 425, 450. And then there was some stuff at 475, 495. The bulk of these sales were between 425 and 490. But then I had the anomaly, the investor house that was flipped that sold for $580,000. It sold $40,000 above list price, Lewis.
Mm-hmm.
So when you have that, okay, so then now me as an investor, what do I say? I say, okay, I got this great renovated comp over here. I have a similar style house. I could potentially buy this for $375,000. So even if I think that he reached, and got a little bit more and I can't get quite as much, I might still say, hey, I'll buy that house for cash for $375,000. I'll go in, put $30,000, $40,000, $50,000 into it, and I'll put it back on the market for $525,000, $530,000. Right?
Yeah.
Well, now once again, I'm now another high-end comp. I'm at the $525,000, $530,000 because I went in, I put this. It's now pretty much a turnkey home. It's got.
And it's the most attractive home on the block.
It is
for a young professional couple that don't have the time, wherewithal, or interest in fixing it up. They can afford that house at $525,000. They're going to buy it.
Absolutely. And
I'm going to buy it at $385,000 while they're working and have workmen for 3 months tearing up their house.
Exactly. And
or they're not going to stay in their place and finance that work while they're still living in the other place. They can't afford to do that.
And not to mention, all those other homes that are still priced at the $470,000, $480,000, $490,000, and they're not fixed up, they continue to sit on the market.
Right. And that's why you have low sales but higher prices, because the homes that are priced to sell, even if they're priced higher, I mean to sell because you can move into them, they're more attractive, they're the ones that are going.
Yeah,
in a real efficient market, the other homes or consumers would see the value in those homes and they'd buy the lower price home, but it's not as simple as that because they don't have access to capital to be able to do that because they either can't get a loan or they can't afford to have two places being under mortgage, or they can't get a loan to have two places being under mortgage while the other place gets fixed up. So they rely on investors to fix them up, and then investors reap a larger reward for having that access to capital. And that's another example of how QE and low interest rates helps the rich, because if you have money, you can go ahead and make money.
Well, and I'm glad you brought that up, because on this same property that I was looking at, I'm not the only one looking at this property, by the way, right? There's plenty of other people that are looking at it that have loans. That are potentially guess what? When you have a loan, there's now a potential that the lender's not going to approve that loan because the house needs work or it needs work done. That they're not willing to lend on it until the work's done. So rehabilitation loans, they're few and far between. They're harder to get. The higher rates are the underwriting guidelines are a little bit more stringent. Now you can get them. It's more of a process. It's a longer process versus me. If I come in and somebody offers $385 and they're going to get a loan, but I offer $375 in cash and I can close in 7 to 10 days.
Right.
Who's going to win there? I'm going to win.
If the time value of the $10,000, and having it possibly not happen, it's negligible to cash in hand at $375 in 10 days.
Do you know? And this kind of is an interesting point, but I have a lot of buyers Lewis, that come to me because after they're frustrated because they've been looking for the last 5 to 6 months and they're looking in a very tight price range, they'll go, Ryan, can't you just go buy me a house and fix it up and sell it back to me? Right? Because they're so frustrated that they can't just buy a resale because their price range is very stringent, or they can't buy something because it's an auction property and it's got mold in it or whatever else, and they don't have the ability to get a loan for it. So they're asking me if I can buy them a house. And now, granted, I could.
Well, in a way, you do that.
Yeah, and I do.
Not particularly on contract for an individual, but when you buy a house, fix it up and sell it, that's what you're doing. You're doing that for somebody else for a fee.
Well, but what's funny is now my clients that I'm showing houses to, they know that I also do investing on the side. You know what I mean? The frustration ultimately leads to them to asking if I can do something like that. But ultimately, what that does is it drives their price up, right? Because they were looking at
it's driving the price up anyway, isn't it, Ryan?
Well, it is, but they were looking at resales before, right? But they can't get a loan on those resales they want because they need work. Mm-hmm. So if I get it and then I have to go in and fix it so that they can buy it to get a loan, it's going to go up higher because now I've got renovation costs and everything else involved.
Right, but in general, are you not doing this type of activity in areas where you might also be selling resales, or no? You're doing it in a separate area?
Yeah, absolutely. I mean,
then you could sell them you could say, look, I'm almost done with this one. You can buy that one. It's done.
Right, and that's pretty much what we most of the time do, and that's why you see that. And it's no coincidence that we have, such a large percentage of transactions that are cash right now. But, and there's even a more interesting statistic is that there's so many sales that are actually taking place that are off of the MLS, right? That
yes.
They're just being, from an pure, investor that's going up to a homeowner and buying it with a contract that never hits MLS, so you never really see it. It just shows up as a public record later that there was a transfer, right? There's so many more of those sales taking place right now. There's, assignments of contracts where there's a wholesaler that gets the property under contract and then sells it to another investor. And then after that investor rehabs and puts it back on. I mean, there's so much of that going on right now, and there's such, I would say it's like Investorville all over the place, especially in the D.C. metro area. But as you mentioned, as inventory starts to rise, it definitely will give investors pause before they start to buy up the mass quantity that they were buying before.
Right.
Because you don't want to be, if the inventory is rising, then all of a sudden, you're not only going up against the other resellers, you're going up against other investors. That's going to force your prices back down.
And when investors leave the market because it's no longer yield effective or worth your time to engage in that activity, then you remove another peg of the demand, and prices have to come down because who's going to buy the homes? Casey Jr. blog, whatever it's called, can say millennials are going to buy them. They can say boomers are going to buy them. They're not. They can't. They may want to. The boomers don't even want to. That's ridiculous to think that boomers are now in the housing market, especially the more numerous of them, because boomers are most numerous, at the older age levels. They're not looking to buy houses. They're looking to downsize.
Yeah.
And millennials, they may, as you say, they may be interested, they may be willing, but they're not able. So, and if investors are out of the market, who's going to buy all these houses?
Yeah. Well,
unless they got to come down in price, then there'll be demand for them, of course. Ryan, if there's demand for homes and ability to buy them and the prices are right, they'd fly like hotcakes. Everyone wants to buy a home. It's not that people don't want to buy homes. You can tell people don't want to fix it. They don't want to spend the time. They'd rather rent. That's true for some people. But still, at least a strong majority of people believe in home ownership. They just can't afford it.
Yeah. Well, and the thing is that, I have almost an example for every single one of these, but the whole ready, willing, and able. I just got a text message the other day from a referral from another client of somebody that said, hey, I saw this property over there. I'm really interested in buying. I was hoping that you could put me in touch with the lender to see if I could, purchase this. And, he's pretty much, 4 or 5 years out of school or whatever, but he just started a new job. He told me, I just started a new job making, $70,000, and I didn't even have to waste my time sending him to a lender because I told him, well, if you haven't been there for at least a year, you have no shot, right? So he's ready and willing, but he's not able. Right?
He's actually more able than most. That's a nice job, $70,000.
Exactly.
If he can keep it, that's good news. But if he has a partner that makes even $30,000 or $40,000, they're a 6-digit couple, and they should be able to buy a house. That's what's really a shame in this country is you make good money.
Yep, and
the few that do, they still can't qualify.
But guess what? Yeah, because of a low interest rate environment and because of increased underwriting standards,
right,
they can't qualify for a house. Now, how many people out there actually do you think know that you have to pretty much be in your job for 2 years straight before that you can actually get a home loan? How many people know that?
They know that after they talk to you.
Exactly. They don't know until they have the first ready and willing part, right?
Right.
Then I have to be the one to tell them that they're not able to buy. Right?
And meanwhile, they're thinking, they're king of the world here. They just landed a $70,000 job. It seems secure. It's within their what they went to school for. They can't buy a house.
Yeah, not only did I get $80,000, Lewis, I also got a $15,000 signing bonus, so I got money for a down payment. So I'm gonna go buy next week. Right?
Yeah, he wants to buy a condo in the $300,000 range. Should be able to do that.
Exactly. You may be able to go buy a car that way, but you sure can't buy a house that way.
The cars are ridiculous. I bought a car recently. They don't even hardly even check your ID.
No, it's just.
I guess they figured they can repo the car if it doesn't work out. I don't know, but there's no questions hardly even asked.
No, they'll ask the questions and plug them into the computer, but there's very little verification of anything.
Right, unless you're sitting there saying, I am committing fraud. I am not who I say I am, and I'm going to take this car and go on a joyride and drive it into the bridge. They're going to give you the car.
Right. Yeah, and it's interesting how different those worlds are, the auto loan world and the mortgage lending world. But when I want to make this point again that we are here to help people make better decisions and help. Obviously, I want to help as many people get into homes as I possibly can, because the more people that I can help get into homes at these low interest rates, it's just protecting them from future inflation and things that are out of our control in the future, right? So the more people that I can help get into homes is what I want to accomplish. Now, the reality is that many people are going to be in a holding pattern until they can get their stuff together. But how do you know what to do or how to get your stuff together? You don't until you reach out to somebody like me that I can kind of lead you down the path.
Absolutely.
And get you so that you can hit those three things, which are ready, willing, and able. I can help you complete the able part, but it might not be just talking to me. It might just be time.
And Ryan, you want to talk a bit about how you can help them also with making sure their credit is lined up?
Yeah, so we also partner with two or three different firms, but the main one is the Credit Pros, and it's an attorney-based credit repair company. And what they do is they legally help repair your credit. So if there's things that are on your credit report that aren't accurate or are not verifiable, they're able to get this stuff removed. And typically, we've seen most results happen in somewhere between 60 and 180 days. 60 being the quickest, sometimes even quicker than that if it's just something that can be removed, one item that you can get a letter and get it deleted quickly. But there's not anything that technically cannot come off the credit report. Many people don't know that. They think that once something's on your credit report that it's stuck there for life, and that's not the reality. The reality is federal tax liens, bankruptcy things, anything that's not on there appropriately or is not verifiable, it can be deleted. But good luck doing it yourself. You're not going to know how to write the letter, who to send it to, how to send it. These are all the things that they do. It's most of the time a minimal charge. I can put you in touch with the Credit Pros, but I can't tell you how many countless people we've helped that way. Now, it's not immediate sometimes. Like, I can't just say, hey, I'm going to send you the Credit Pros and you're going to buy a house next month. In some people's cases, it is. Because in some people's case, they have a 580 score and they only need a 620. They go and they get one or two collection paid off. They pay down their credit card balance from 80% of their high credit limit to 30% of their high credit limit, and all of a sudden they have a 650, right? That's immediate. That's almost 30 days, and they're ready to buy a house. So there's that person, and then there's another person that might have 15, 20 medical collections because they went through a bad period of time where they were really sick and they couldn't get back on their feet. Let the Credit Pros work with you because you could potentially buy a house in less than 6 months from now. As we've seen, Lewis, it doesn't really look like interest rates are going to move out of the range anytime soon.
Not if the Fed has anything to say about it. If they don't have something to say about it, then all bets are off and rates will rise. But they're it is their mission, much more than it is to get people jobs, is to keep interest rates low, and they will do whatever they can. Did you see that Belgium is buying treasury bonds now? They've massively increased their purchases. Who knows where that's coming from? It happened just at the time where the Fed stopped buying theirs.
Yep.
So whatever they have to do, whether we understand how they do it or know how they do it, rates will remain low as long as they're in control.
And it's important for you to be working with a professional that will help lead you down the path. Now, just remember, if you just go to somebody, walk into a bank, and they deny you for a loan, chances are they're not going to lead you in the right direction as to where you should go next to fix your problem, right? They're just going to flat out deny your loan. They're not going to tell you should probably go to a credit repair company. They're not going to tell you all these things. If you are listening to this podcast, I'm basically arming you with a lot of the information. And if you have any questions, all you have to do is reach out to us 877-245-2030 or go to the website, realestate360live.com. There's an Ask a Question button on the right-hand side. There's no question that's off limits. And if I don't know the answer, I can get you the answer. But the important part is that you should be, I think some people think this is funny, Lewis, but even if you're thinking about buying 2 years from now, I think that it's important.
You got to get started.
You got to get started now looking at, could I potentially buy 2 years from now?
Right.
Because
especially if you might have credit issues.
Yeah, well, and not just that. I mean, let's just say that, you're looking to buy a house and, you just started your job. You're probably almost 2 years out anyway, right?
Well, here's another thing that people get shocked about is some real estate agents won't even show you homes unless you have a pre-approval letter, at least a pre-approval letter.
Majority won't these days because they feel like they're wasting their time if they're showing somebody a house that can't get a loan. So, and typically what I do is I typically take the initial meeting with anybody, right? Because I need to be able to evaluate their situation, and I can't do that by just, denying them to see a house. I want to meet with them, find out what their goals and expectations are.
You can also tell them, go get pre-approved, and they can get that done pretty quickly. If you deny them, you may lose a good customer.
Yeah, but the reality is that, I could have somebody that's not ready to buy today that's ready 5 years from now. It's just putting them in the position to do that and aligning them with the people that can help them. Whether it's credit repair or a lender that offers a no down payment. I mean, there's many different factors, but
right.
There's so much misinformation out there, Lewis. It drives me nuts. If people turn to the internet, they look at these loan calculators, they read these articles. So it's embedding all this, to me, wrong information. It's not yet. Is it a great time to buy? Is the spring a great time to buy? Yes, it is. Seasonality of real estate, we know, is always been around. And this spring and summer, if it's nice weather out, I'm sure that there's going to be a lot of home sales, especially in the DC metro area. But there's still many people that are underwater. That's really, we're still kind of a ways away from getting everybody above water. And, loans are still harder to come by. It's really more difficult to get a loan today than it was back, a year ago, really.
Oh, sure.
Really from a year ago. I mean, we have, what I tell you, loan volume last week that was down 55% from the year before.
Ridiculous.
That's loan volume. I mean, that's crazy. But yet, Lewis, we have rising home prices and a rising stock market. Wouldn't you think that loan volume would be up 55%?
Yep, but the fact that it's down means if you talk about a forward-looking indicator, that means that home prices cannot stay at their levels if the demand is not there. When I say demand, I mean the able demand cannot get those mortgages, is not applying for those mortgages, and there's a reason why home builders aren't building more homes. They know this.
Yep.
If there was an inventory shortage, they would jump ahead of the game, and they would be building like mad, and there'd be permits going through the roof. They're not doing it because they know they can't sell them.
Absolutely. And not to mention, it makes sense, right, that loan production is down by 55% when we have almost 30-some% of transactions that are cash, right?
Right.
So it all lines up. All of the information kind of lines up. It's just, the media just chooses what they want to push out there. And now
the word is recovery.
Yeah, recovery.
Can't say it enough. Recovery, housing recovery, economic recovery.
Yeah.
Recovery.
And I'm just waiting. I mean, what's the next thing they're going to say? You know what I mean? Is it?
They recovered through an entire business cycle. You go from improvement to recession and back to,
right.
There's not an extended period of recovery. At some point, they're recovering back into a deeper recession.
Yep. And
they won't give that story up, though.
No, it's we've been down this path for so long now that it's you and I are just waiting for something to change. Like I said, I'm holding firm, not on Obama's dime, and who knows where the next president will take us? Maybe Hillary. It could be a continuation. Who knows?
Or Bush. You just have an Obama slipped in there every 30 years, but otherwise you have Bush or Clinton.
It does. Seem.
Maybe you'll get Michelle Obama or whatever her kids' names are, and you'll have the three ruling family class.
Yeah, well, and we know if that holds true, I mean, not much is going to change. So
it's ridiculous. You got 330 million people in a country, and you can only find a Clinton or a Bush to run to be the party's nominee.
Yep, seems that way, right?
That's just that is a sign that things are rigged.
Oh yeah, things are definitely rigged against you. So and all you can do is look at the cards you've been dealt and make the best of it.
Imagine, if Bush and Clinton were so popular, you could say, wow, these are incredible people. They're beloved by all. They're not.
No.
George Bush had the lowest rating of any president, and somehow we want his brother?
Yep.
Same with Bill Clinton. He wasn't popular when he left office either. And his wife isn't popular now, but somehow she's inevitably going to be the Democratic nominee.
Oh, she'll be the Democratic nominee, and I've already pretty much told the majority of people I know that I think she's a shoo-in to win. But that's just me. To be honest, Louis, the more you and I talk about things, it's almost like I can almost see what's going to happen way before it happens because it's
planned.
It's planned, right? Like the game is so rigged, it's not even funny, and it's unfortunate that it's that way, but that's the reality.
Well, you got to play the cards you're dealt with.
Yep.
Complaining about it doesn't really do you any good.
And so that's exactly what we're going to do here week in and week out is deal with the cards we've been dealt, give people the information that we feel they need to have.
Right.
We're coming up on the end of the show here, Louis. Give our listeners your blog so they can check out your blog post this week.
Oh, thank you. It's smallgold.com, SMAULGLD, blog post every couple of days on real estate, the economy, gold, silver, and the Federal Reserve. So check it out, smallgold.com.
Awesome. Thanks, Louis. Appreciate it.
Thanks, Ryan. Thanks, everyone.
Thank you guys for tuning in. If you'd like to subscribe to our podcast, please go to iTunes and subscribe to Real Estate 360. You can download all the shows there. Also, you can go to the website realestate360live.com to stream all of the prior episodes as well as ask any questions you may have. Take care.